Hello and welcome to this edition of our 4C Fund Manager series. I have with me today Charanjit Singh, Fund Manager at DSP Mutual Fund. Charanjit specializes in the capital goods, power, infrastructure and consumer goods sector. He's also an award-winning analyst in the past. He has an overall experience of over 18 years and he's been with DSP for over 5 years. Welcome to the show, Charanjit.
Thanks for having me on the show, and it's pleasure in interacting with your viewers.
So let's start with your investment style. How is it that you have evolved your investment style across these years, and how do you look at fundamentals when investing into the businesses, and how do you take a look at valuations as well?
Yeah. So when we evaluate any kind of a business, I think the most important aspect is look at the opportunity size which each of these companies are going to have. Secondly is what we are seeing is that the changes in technology which are so rapid, whether the companies are able to change themselves with the changes in the technology. Definitely fundamentals in terms of how cash flow generation is, how the return ratios are, how the market structure is in terms of whether it's a consolidated market or a fragmented market. That is also what we look into when we are picking businesses. Longevity of the cycle is very important in cyclical businesses. Generally, you may have a cycle of maybe 3 years, 5 years or 8 years. How and the companies are positioned within each segment, that's very critical for us to pick up businesses. From valuations perspective, we will look at companies which have the ability to capture larger part of the market. Secondly, we'll also look at companies where there is no other option available, because there are certain business segments and technologies which are evolving. For example, data centers, for example, 5G capex. These are the opportunities which very few companies will have the ability to capture these segments. Whereas there are certain segments which might be very commoditized. So those are the businesses which might trade at much more lower valuation multiples because there is more fragmentation in the market, less pricing power. There are also businesses which might be also at a lower end of their ROE profile. So they are getting into a turnaround mode. So I think when you're building a portfolio, I would like to keep valuation as a very relative thing. There are businesses which have very good strength and which can keep on compounding their earnings. So there we don't see the valuation derating happening. It's more about the earnings growth. So even if the valuation is expensive, but they are able to grow their earnings at a faster pace than the other segments. Then there are companies which will be at the bottom of the cycle, where you will have lower PE, earnings would have deteriorated significantly, but we are getting a visibility that they are drivers for the earnings to improve, and there we will like to play a PE re-rating as well as an earnings growth story. And then there are companies which are seeing a very good opportunity just evolving, which street is just not able to visualize right now, and that is where we need to capture some of these stocks much ahead of the street and play the cycle of next 3 to 5 years. That's how we try to pick businesses in the market.
Right. How do you ensure margin of safety in some of these businesses?
Yeah. So I think margin of safety comes from the factor what is that the street is estimating in the future estimates. So what we look at is that one, look at the long-term historical growth rates, long-term margins for these companies. And then we see that what is the potential upside which can come in the future numbers. What's the kind of growth which they can deliver. So if there is a much lesser growth factored into the future numbers, but what we see is that the companies have an ability to surprise us positively. They have the ability to capture much more market share than what the street is anticipating. Plus there is a valuation comfort. So if they are trading at a lower valuation multiple or maybe at a -1 standard deviation multiple, that creates much higher margin of safety. The expectations for these stocks are generally very low, and when they give us a positive surprise, then significant PE re-rating happens as well as earnings growth starts coming in. I think those positive surprises are very important for stocks which are going through a very tough time and start delivering the numbers. That's where the real returns get generated.
Right. Now coming to your core area of expertise, which is capital goods and infrastructure oriented sectors, we've already seen that the government has announced a large budget in terms of capex, and there typically are 3 pillars for overall capex. The first is government, the second is private capex, which is companies, and the third is household, which is real estate. Now from a private capex standpoint, do you see the emergence of a new private capex cycle actually coming through? And how could it be very different from the 2003 to 2007 cycle?
Yeah. So I think that's a very important question because private sector is an important pillar of capex cycle. So what we are seeing is, let's look at the data points, how the private cycle picked up in the last cycle of 2003 to 2007, like you rightly mentioned. So at that point of time, government did a lot of reforms. These reforms were like in the power sector where privatization happened. And these reforms led to this significant pickup in the capex cycle. It was also led by the commodity boom, which again, delivered a big capex cycle for us. Now, if we look at the data points at that point of time, when we see FY06, private listed companies were doing 1.5 lakh crores of capex, and that went up to around 4 lakh crores and then 6 lakh crores subsequently by 2011. What we see is a significant scale up when the cycle comes in terms of the capex by the listed companies. But post GFC, and as the demand cycle got disrupted, what we saw is that for the last 10-11 years, the private capex has been flat at around 5.5 to 6 lakh crores on an average. Now, the most important point is, what are the data points which we are going to track to make sure that the private capex cycle is picking up? So one, if you look at the now listed space capex, already for the first half, we are seeing capex being done at around 7 lakh crores. Second data point is on the project announcements. Project announcements are the lead indicator. Most of the companies will announce the projects that they want to go ahead and execute or build up new capacities. If you look at that data, in the previous cycle, that data was showing us that 14 to 15 lakh crores of annual project announcements being done by the private sector. And this data for the last 10 years was again very weak at around 8 lakh crores on an average. But in 22, we saw this data rising to 14 lakh crores, similar to what we saw in previous cycle. 9 months of FY23, we saw it at around 13 lakh crores. So this is a very good lead indicator for us to believe that we are at the beginning of the private capex cycle. The capacity utilization data as per RBI is showing 72% capacity utilization. But if we move forward and see the demand growth which is coming because of the government capex, the capacity utilizations in next 2 years time frame will reach more than 85% level. If that is happening, you need to start planning your capex right now. You need to start thinking about awarding orders for your cement plant, for your steel plant. That is how you need to start planning, because each of these, setting up of plants will take 3 years or 5 years time frame. You cannot just come up overnight and start adding capacities. Apart from this, the private sector balance sheets, they are at a very strong, footing. Most of the private companies, they have done significant deleveraging. There is significant amount of cash on books. So if they have to go ahead and do the capex, they can start doing it from their internal accruals itself. The profitability for the private companies has increased significantly over the last couple of years. Now, the policy measures which are there from the government side, that is again a very important ingredient for any capex cycle to start. What we see is over the last 5 years, government has taken very significant policy steps which are in favor for the capex cycle to revive. One of them is for the new manufacturing capacities, tax rate has been brought down to 15%, which is the most competitive amongst all the Southeast Asian geographies. We are going to compete with them. Additionally, what we are seeing is that government is realizing that private sector also needs incentives. So various production linked incentives, those kind of schemes are being brought in. So I think there's a very big confidence among the private sector looking at the demand environment which is picking up, that they can go ahead and start doing the capex.
Right. And some of those areas that you mentioned, especially manufacturing and PLI, how do you think the entire China plus one kind of figures out from an Indian perspective, and which sectors could actually stand to benefit?
Yeah, so I think when you are saying China plus one, it's a very important question, because what I am seeing is it's a once in a lifetime opportunity. It's the opportunity which India needs to seize now, because we are going to become a factory to the world or manufacturing hub to the world. What COVID did is, COVID made people realize that we have having a over dependence on China for manufacturing. A lot of components, in a lot of products, China is manufacturing to the scale of 50 to 80% of the manufacturing output which is required by the world. Now that creates a lot of risk to the supply chains. That creates a lot of risk when there are a lot of geopolitical issues what we see with China going on. So that is what COVID told the world, that we need another partner. Who that partner could be? India. So India is trying to seize that opportunity by having right policy measures. So you need policy in terms of having incentives. and also having import bans. While everybody will say why we were not doing manufacturing 5 years back, because we were not that focused. We didn't realize that what importance we have in terms of manufacturing. But I see now it is the beginning of a new era where manufacturing, which has been at around 15% of GDP, can see a significant increase as a percent of GDP. Government has already come up with production linked incentives where you will be getting 5 to 6% of your revenue as an incentive if you set up capacities. Now we need to understand what government is trying to do. We are importing electronic equipment, mobile phones, we are importing oil, we are importing defense equipment. So we are becoming one of the largest importers of some of these items in the world. We cannot have that when we have our own domestic demand base. So that is what government has done. Give incentives through production linked incentives. Also create barriers in terms of import bans, which is now going to create an environment that you cannot import from China, you don't have an option, and you need to set up a manufacturing capacity in India. So like you're rightly saying, you will see a very big ecosystem getting developed. There'll be large MNCs who have committed capex to set up facilities in India. To give you a number, $30 billion of incentives are being given by the central government as per the production linked incentive scheme. If you look at the capacity additions or the capex commitment is $60 billion over the next 5 years. So I think that's a big credible number, and that's number which is not going to change because these are like large multinational companies. If you look at Apple, their CEO Tim Cook was here because they are seeing India as a growth market.
Right.
They are trying to say that 25% of the Apple iPhones will be manufactured in India by 2025. So I think these are very big statements and these are not going to get reversed. Plus, what we are also seeing is that the commitment from the private sector is increasing, be it solar modules, be it battery manufacturing, be it room AC components manufacturing, chemicals, pharma. These are all the areas where the manufacturing is going to happen. Now coming on to the beneficiaries. So first you need companies who will set up these plants. Secondly, you will need machinery, which is the process equipment which will go into these plants. Then you need the raw material which is going to be required to run these plants. So I think there is an entire ecosystem of manufacturing which will get developed in India, which we have not seen in the past. So I think that is where we need to focus on, that there are multiple beneficiaries of this big manufacturing rise which is we are seeing in the Indian context.
Right, and considering that manufacturing and capex is such a broad theme, which particular sectors do you think really stand to benefit? And with respect to the previous cycle that we had, which are the sectors that could be new emerging sort of sectors to sort of lead the entire recovery?
Yeah, so I think that's very important for anybody to bring into the perspective in terms of what's happening. Now when you talk about the first pillar, which is the central government capex, there what we are seeing is railways is getting the biggest attention from the central government. And where is railway spending? In terms of, we want to increase our average speed, we want to increase the share of freight in railways, we want to decrease our logistics cost. So railways is going to require setting up of new lines. Railways is doing electrification, so what it means is it requires a lot of electrical equipment. Right. Railways is acquiring a lot of wagons, locomotives, so it requires a lot of bearings. Lot of components and products go into this entire capex of now 3 lakh crores in FY24, which used to be 50,000 crores in FY12. So see the scale up which railways has seen. Now coming on to the another segment, which is defense. Now what is happening in defense? Now defense, India is the second largest importer of defense equipment globally. We have 60% of our inventory which comes from Russia. So what Ukraine war told us is that you have your Sukhois which are there, but you cannot fly them because you don't have the spare parts. This is the first time now we are talking about a two-front war. One side China, another side Pakistan. So if you have that kind of a scenario and you don't have self-reliance in the defense space, you are going to face a significant issue. That's where government has again brought in a very big change, where over the last 1.5 years, the policy has been changed in terms of ban on imports and indigenization of the defense equipment. I think it is very much possible over the next 5 years, the companies in the defense ecosystem will grow like, leaps and bounds, and this opportunity is expanding as the defense budget, which used to only cater to around 50% coming from the domestic companies. Now we'll see 75% coming from the domestic companies in next financial year. So this proportion of sourcing from domestic companies is rising consistently. Now coming on to the other parts in terms of the new drivers, what we are seeing. So what we are seeing is data centers. Now data centers is an opportunity which we didn't even talk 1.5 years back. It's a very new opportunity. Now again, a very important regulation driven thing, where our data which was earlier getting stored in some of the international geographies, now because of regulation has to be stored in India. So what you are seeing is that there's a rush to add data centers. Now why data centers are required? Because everywhere you are seeing there's a push towards digitalization, there's a push towards more and more automation. So the amount of data which is getting created in India is humongous. And that's going to create a very big, large opportunity for data centers. Renewables is definitely a new driver in this capex cycle. Similarly, what we'll see is green hydrogen becoming a new driver maybe next 2 years down the line. So in a way, we are getting a cycle which is going to be much longer, much stronger than the previous cycle. It could be a 5 years or even 10-year cycle as we sit here and look forward. So I think that's what is giving us the confidence that as an investor, you should not be missing out this opportunity.
And how do you see the other important sector, which is power?
Yeah, so I think power is a very exciting sector and it has been a neglected sector. It looks like a boring sector. But power, I'll give you an example now what is happening in power. So power, if you look at last 10 years, our average power demand growth has been almost around 5.5%. And why it is that? If you look at the mix of the power demand right now, 24% of the power demand comes from the domestic or the residential part. 45% comes from the industrial segment. Now what is happening in the domestic side or the residential part, the demand for power is being driven by cooling requirement, the room ACs. Plus, Indian government has done very high level of electrification now. So electricity is now reaching households. So what we are going to see is, the main point is that we are going to see a positive surprise on the power demand growth. What it means is that you need to invest at the infrastructure level for the power requirement. Plus, what we are also seeing is when you look at industry, so if you look at last 8 to 10 years of data, our GDP growth rate was getting driven more by the services segment.
Yes.
Now what we are talking about is we are talking about manufacturing, which is power intensive. We are talking about the capacity utilizations of the existing capacities going up. We are talking about data centers which are power guzzlers. We are talking about other so many processes which are going to come on stream which are again power guzzlers. So what it means is that on one side, we are changing our mix of energy from oil to electricity by getting electric vehicles, by installing more data centers, by having more and more electrification of railways, which has reached almost around 100% electrification. But how we are going to manage the input of this power? So what we are saying is that power is going to see a significant uptick in the capex. Now I know that power is a very broad theme.
Yeah.
But it's a very big value chain. You have cables, wires, conductors companies, because everything will require reconductoring. You have transformer companies. So you have the companies which do the entire EPC work of these setting up lines. So that is the area where the spending will increase. Even the utilities will see repricing of the assets because the deficit as it starts rising, that is what is creating more and more demand for power. So I think that power is going to see a good amount of capex build up. Because even if you are talking about electric vehicles, so you cannot have it without having an EV charging infrastructure. It requires your charging stations, the back-end transmission lines. So that's the kind of humongous cost which has to be put in. And to give an example, we are already seeing that happening in the developed countries.
Right.
In US and Europe, which have got advanced grids, they are spending on the power sector significantly because they are seeing the requirement rising as they are also moving towards electric vehicles and more and more electrification.
Right, great. Now, from an investor standpoint, what becomes extremely important is the valuations that you're really paying for such businesses. And over the last 1.5 years, you have seen some kind of a rally in some of these segments.
Yeah.
How do you look at valuations across some of these sectors?
Yeah, so see, valuations, like I talked about, are relative. One is when we are at the beginning of the cycle, you are able to forecast maybe 10% or 12% kind of a growth. But what happens is when the cycle picks up, the growth starts surprising you positively. Growth can be much higher than what we are expecting. So it means that my earnings are going to be much higher than what we are expecting because One is your top line growth, plus you get operating leverage, so your bottom line growth can be much more faster. Another important point is if you look at last 10 years were very brutal because there was not much demand. A lot of weaker companies, actually they fell through. What happened is that there are only few companies which are left in the market which are strong. Plus they didn't add too much capacity because they were not able to see the demand at that point of time. So what we are going to see is fewer companies who will be able to cater to this demand, who have the ability, start also getting pricing power. So that is how the opportunity will size up. The other aspect is, so I think the first important point is whether this opportunity is growing.
Yeah.
Whether this opportunity is growing for next 3 or 5 years, that's the first question which we are trying to answer. And if we get the clarity on that, it means that our earnings is definitely going to be sure for a lot of these companies and going forward for a longer time. Now within that, we have to be careful in terms of the valuations. So definitely we look at companies which have better valuations, cheaper valuations, so that there's a margin of safety. But then there are certain businesses which are not replaceable. There are not companies which have that kind of technology or edge where you need to pay up. But you are sure that when the opportunity comes up, these are the companies which will be standing there and capturing that opportunity. Other aspect what we are also seeing in a lot of companies is the optionalities which are emerging in terms of exports. A lot of MNC companies, their parents as part of Europe Plus One or China Plus One are adding capacities in India. Now those are the things which will happen in the future because they are seeing that Indian market, domestic plus sourcing from India is going to become a big thing. So I think these are the optionalities which will play out. While on a 1 year basis, some of the stocks which you would have seen would have run up. But I think there are a lot of parts within the market, within the segments, there are companies which still offer opportunities because these opportunities are visible for the next 3-5 years, clearly.
So it certainly looks that we are in for a structurally strong capex cycle, going forward.
Yeah.
On that note, thank you so much, Charanjit, for your time.
Thanks for your time.
Thanks.
Thank you.